While the everyday person is drowning in credit card debt, struggling to pay their bills, the average household in America is $33,000 in credit card debt, and they're also being led to think that home ownership is completely out of reach. But what if I told you there is factual information that is not being shared with you? This information can not only help you save money, build wealth, but it can also increase your credit score, and it's things that you can start doing today that don't cost you any money. By the end of this video, if you ever thought building wealth, saving money, and actually owning a home was impossible, I'll promise you, your thoughts will be totally different. Now, what I share with you is not only what banks are keeping from you or they don't want you to know, they want you to know this information. However, their hands are kind of tied. I'm not a mortgage banker, mortgage broker, never have been. However, forgive me for not introducing myself. My name's Wayne Turner. For nearly 30 years, I've done just about everything in real estate. Bought, flipped, sold, you name it. I've helped thousands of people purchase and sell their homes. And I only share that with you so you can have the assurance knowing that what you learn from me is from actual tried and true experience. This is factual information. So let's take buying a home, for example. There are really only 5 ways in which you're going to get a loan to purchase a piece of real estate: VA, USDA, FHA, conventional, and then private money lenders from either a private bank, small bank, or hard money lenders. But why is it? And don't get me wrong, all of those can be a little bit complicated because every person's financial situation is different. But at the end of the day, and I'm sure you agree, give me a thumbs up if you do, you just want it simplified. We just want the simplest way. We want the loan that works out best for us. And we want to deal with people that are helpful to let us know, here's what I owe, what's best for me. So here's one you may not know, and there's a bunch of them I'm going to share with you, is banks love to loan you money. Cars, houses, motorhomes, you name it, they'll loan you money. And they love to loan money on credit cards because most of those interest is 20 to 25%. However, what they don't tell you, which will help you drastically, is you don't have to pay off your credit card completely to build up and boost your score. At the bare minimum, you want to pay the minimum monthly payments. But one rule of advice that you always need to hang on to, and that is whatever your available credit line is. In other words, if you have a $1,000 line of credit, in other words, your credit limit's $1,000, and you have that thing, you owe $900 on it. If you can keep it below $300, below the 30% mark, whatever it is, basically if it's $5,000, you want to keep it $1,500 or below as far as your balance. By doing that, it increases your score drastically. You're paying that, it's showing you a good positive track record of paying it, and will increase your score instantly. So here's a good one. Give me a thumbs up if you're liking this video so far. Leave a comment, ask us questions. I promise you, I do my very best to answer every single question. But here's a never, ever, ever, and that is an adjustable rate mortgage. Perhaps you've done one, it's worked out for you, but you're rolling the dice. It's gambling. An adjustable rate mortgage is not a matter of if it will go up, but when it will go up. It's just a matter of time. You just never know. A lot of people say, well, Wayne, I'm only going to be in the house 3 to 5 years. I'm saying, well, I'd still do it on a fixed rate. If you're going to be in 3 to 5 years, at the very minimum, put it on a 30-year pay extra, or put it on a 15. But when you do an adjustable rate, it's a little bit different now, meaning that they qualify you based on a 30-year fixed rate, for example, of 6.5%. Although you may get a 4.9% rate, which, boy, that looks good, and that payment's nice. However, once that payment starts to go up, it can go up and up and up and up. And there were so many people that bought homes and put them on adjustable rate mortgages in 2006, 2007, and 2008. And guess what happened? Their mortgage payment kept going up. When your mortgage payment goes up, the equity goes up, all of a sudden you find yourself in a pickle with your job. Word of advice, when in doubt, just do a fixed rate loan. Now another one, and it's fact, and I don't know why banks and mortgage companies don't share this with people constantly all the time. We see TV commercials and all this other stuff on the internet, but at the end of the day, you don't need to have a super high credit score to buy a house. People think you got to have your credit score in the 700s and 800s. Listen, if you're a veteran and you can get a house VA, 580 credit score, that's the minimum. What about FHA? I got lenders that do FHA loans all day long, 600 credit score. What about USDA? USDA, United States Department of Agriculture, 620 credit score. A house just like this I'm walking around, $269,900 on an acre of land. It's all brick, it's about 45 years old. It's a nice little place. You can buy a home like that. VA, FHA, USDA, all of those with the credit scores that I just shared with you, and you only need $1,000. $1,000. That's why I say this is important. Now here's a new one that's a huge benefit to a lot of people. It may not affect you directly, but if you know of anybody, that's why I say share this information. It's medical bills. Medical bills can no longer show up on your credit report to ding your credit. It used to be if you were late on a medical bill, $127 or $117, we've all heard or had or seen that happen to somebody, but they can't do it anymore. They've deemed that illegal. So they no longer put medical bills on your credit reports, collections, or anything like that. So you want to make sure it's off. They're gradually getting that off. They just started that in 2025. So regardless of when you're watching this video, after you watch the complete video and take some good notes, you'll want to pull your credit report at Credit Karma, one of the free ones, even if you have to pay for it, get access to your credit and make sure the medical bills aren't on there. If they're on there, you can simply contest it and get them removed, and you'll be amazed. Your credit scores, people's credit scores are jumping 40 to 60 points overnight. But I, for the life of me, don't know why banks, mortgage companies, lending institutions, they run, advertise, do all this other crazy commercials. They got little beetles driving bugs and everything else. But what they don't tell you, and what they should tell you, is just to simplify it. Just simplify it. Say it's VA, it's FHA, it's USDA. You only need these simple credit scores. You can also have the seller pay your closing costs. And my agents that I have all around the country in every single county, city, parish, you name it, we get closing costs paid. Builders pay closing costs, sellers pay closing costs. Why? Because they want you to buy their home. And if you buy their home, they'll gladly pay your closing costs. Now, when they're paying your closing costs, that allows you to get one of these homes for little to no money out of pocket. Now, for example, VA, if you're a veteran, you'll want to use your VA eligibility. And here's the reason why. If you go VA, you do not have to pay private mortgage insurance. That's an insurance policy that the lender takes out if you don't put 20% down on the property, because statistically proven you have a higher chance of that home being foreclosed. They do it with everybody. Doesn't matter who you are or your credit. You can have a 900 credit score. But if you don't put 20% down, you're going to have to pay private mortgage insurance. However, with VA, the federal government, the United States government guarantees those loans. So you don't have to pay private mortgage insurance. Now here's another quick trick that a lot of people aren't aware of. If you close at the end of the month, you won't have a mortgage payment for 60 days. So if you close at the end of any month, you don't have your first mortgage payment for 60 days. Now here's one that's a loose term that's been flipped around forever, and that's approved or pre-approved. Listen, you're just approved. You're not pre-approved. That's just a term that real estate agents kind of coined when it's like you're being pre-approved for this house. This is something that you need to know. Once you're approved, you are approved. It has nothing to do with the house. And the worst thing you can ever do is look at a house and not be approved. Now there's a difference between being qualified and being approved. Now being qualified, you're talking with a lender. They're not pulling your credit report. You're just telling them this is what I owe and this is how much money I have coming in on a monthly basis. And they will tell you, you should qualify for this amount of money or this home. However, if you want to get approved, they want to see bank statements, tax returns, proof you've been on your job for 2 years, verification of income, and they will approve you. And once you have an approval letter, it's like having cash. They're good for 60 days. And I can't emphasize enough, it has nothing to do with the house. It has everything to do with you. So get approved. There's no pre-approval. You're pre-approved before you buy the house. At the end of the day, cut all that. You just want to get approved for a home. They're good for 60 days. If you won't buy a home within 60 days, it's super quick and easy for them to update your application and reapprove you for a home loan. Now here's what I'm excited to share with you, and it saves you huge. I'm talking hundreds of thousands of dollars. It can depend on the price of your home, but at the very minimum, it'll save you tens of thousands of dollars, and that's putting your mortgage on a 15-year note. You see, a lot of lenders won't tell you that they actually discount the rate if you put it on 15 years as opposed to 30. You heard me correctly. They discount the rate. So for example, if the rates are 7% or 6.5%, for example, if rates are 6.5%, you're going to get a 5.9% rate with most lenders if you do a 15-year term. And I cannot emphasize enough, when you paid on your home for 5 years, you've paid a third of your mortgage balance. You pay so much more towards the principal balance and so much less towards the interest. So when in doubt, if you can, put your home on a 15-year mortgage, because you will wake up in 5 to 7 years and go, wow, my home's not only half paid for what I bought it for, it's gone up in value, and now I owe far less than what I did when I bought the home. And that is the way you save money, and that's the way your home is a forced savings account. So one that everybody always says is your payment never goes up. No, your principal and interest payment never goes up when you buy a house. When you own a home, your principal and interest balance stays the same if you put it on a fixed rate. However, your payment can and it will go up. I promise you it will go up. And here's the reason why. Homeowners insurance increases over time and taxes increase over time. Because what happens is you want your home to go up in value. Well, now the taxes, and don't get me wrong, I wish we didn't have to pay taxes on residential property. That's my opinion. I don't like that. I think if you bought something one time, I paid taxes on it, I shouldn't have to pay it for the life of the house. Give me a thumbs up. I'm sure you'll agree. But at the end of the day, it can go up because your home goes up in value. And now, as I was saying, real estate is connected to the multiple listing service. It's connected to all the real estate data, appraisers data, homeowners data. It's connected to everything. So they know and see when home values are going up and they reassess your property. And listen, it's a good thing to have home values go up, but unfortunately, your mortgage payment will increase. It doesn't increase a lot and it doesn't increase every year. Most of the time, your city and county taxes are assessed every 2 to 3 years. Some of them do every year. It just really depends on the city, the county, and the state of them assessing your property. Now here's something that I want you to do, and that's to ask anybody that bought a home 5 or more years ago what they think their home's worth today. Or Google their property address. If you know their property address, ask them what they bought the home for. Google their property address. They can see what Zillow's estimate. Don't get me wrong, that's not right. That is not right, because usually it's a little bit lower, it could be a little bit higher, so those Zillow's estimates aren't always right. However, it'll give you a good ballpark within 5 to 7%. But you can see what somebody bought their home for and what it's worth today. Even you yourself, you may want to do that to see, wow, I have a lot of equity in my home. Listen, owning a home is a forced savings account. And if you really want to build wealth faster within your home, here's a quick little trick. Pay one extra mortgage payment towards the principal balance every year. We'll take a 30-year loan to a 22-year loan. You'll pay your home 8 years faster. So what a lot of people do is come income tax return, if they've got a $1,200, $1,300, $2,700, whatever the mortgage payment may be, you get money from your tax returns. Write a separate check, mail it to the mortgage company, and put apply towards principal balance only. Write a little letter in there. They'll apply it just towards your principal balance. You won't get charged interest on that money, and it just pays down your principal balance. That way, your home gets paid off in 22 years as opposed to 30. Now I have a question for you, and listen, it's okay to chime in, to give me an answer, to leave me a comment, give me a thumbs up if you like this video. The question I have for you is, you probably don't realize that so many people are locked into their homes. They're trapped into their homes. You heard Jerome Powell say the same thing. He's probably watching these videos because I've said it over and over again. People are trapped in their homes because they got such a low rate and they've been in their homes. Well, the homes around them have gone up in value. So now many people are trapped in their homes. If they wanted to sell their home and just roll all of their equity into another home, home values have gone up. Not only have they gone up, mortgage interest rates have doubled. It's important to know that literally in the year of 2022, mortgage interest rates in March of that year were 3%. From March of that year, beginning in April of that year, mortgage interest rates went up and up and up and up to the point where they doubled. October of that year, those mortgage interest rates were by that time 7.5%, more than doubled. So you see what has happened is homeowners are literally trapped in their homes. You may be one of those. You may be one of those where it's like, Wayne, I can't move. I have people all over the country say, I can't afford the house that I personally live in now. But here's what's important to know, that oftentimes people have credit card debts, student loans, medical bills, vehicle payments, and they're not aware that they can actually get qualified for a new home based on their income and putting equity down on another home. Imagine if that credit and that debt didn't exist. If none of that credit, none of that debt existed, it can be paid off with the equity of your home and you can get approved. So for example, we help people all the time, and I'm not trying to sell you on anything. I'm just giving you this information so you can make the best informed decision for you and your family. If you own a home and you have $100,000 in equity, but you have $50,000 in credit card debt, you can get approved for a new home by taking some of your equity and completely paying off your credit card debt. Many people watching this have credit cards that they're paying 20, 25% on. But you may look at buying a new house and paying 6.5% because the rates have gone up and thinking, man, that's a high rate. I don't want to do that. Just know that you can get approved for a new home without your debt, without any credit card, whatever you want to pay off. They will tell you, good lenders that we work with will tell you, hey, if you paid off this and this and this and you didn't have these bills and you paid them off with the equity of your home and then took the remaining equity and rolled it into another home, or if you're a veteran, you want to do FHA, you can do all kinds of loan types that don't need a whole lot of money. You can get a conventional loan for only 5% down. The seller can pay closing cost. So yeah, if you have $100,000 in equity, $50,000 in credit card debt, you can pay $50,000 in credit card debt, put $25,000 in your pocket, buy a $500,000 home, put 5% down. That's $25,000 on that home, and you just bought a $500,000 home. Now you may have a 6.5% rate, but you have to look at what are your monthly bills right now. Sit down at the dining room table tonight and look at, man, we're paying credit cards, we got the four-wheeler, we got the boat, we got all this stuff. We're paying $200 here, $100 here, $400 here, and then we're paying 24% interest. Hell, you can sell a house, upgrade, pay it all off, and then be in a house, perhaps a house with a pool, perhaps a house with a garage, perhaps a home on the water. As I mentioned, I'm not trying to sell you anything. I'm just giving you information so you can make the best informed decision. Listen, I'm Wayne Turner. I hope you enjoyed this video. Please give me a thumbs up, like it, subscribe. I'll do everything within my power to teach you something new on every single episode.